I want you to think about the people that retired in 2007. Now, we all know that the market had a huge correction in 2008. The S&P 500, depending on which report you look at, and people's portfolios on average lost somewhere between 37 and 50%. And if you put this money in at that point in time, and you got an interest rate on it, and it's safe, it's going, and we had a major market correction, they completely avoided that. And not only did they avoided that, they gained in those years.
Hey everybody, welcome back. This is Kylee Mollotte with Retirement Fundamentals, joined by our co-host Ryan Anderson. This platform is purely for those entering in or already in retirement. So are you getting ready to retire and you're going to the promised land? This is for you. Today we have a couple questions regarding MYGAs. So the first one is, Ryan, I'll hand it over to you, but what is a MYGA?
Oh, fantastic. All right. A MYGA is known as a multi-year guaranteed annuity. And this is a vehicle that a lot of folks use in retirement for accumulation, for safety, for basically to kind of pigeonhole funds for a future date. The thing about it is they operate very similar to a CD at a bank. There's a couple of big differences though. A CD at a bank has FDIC insurance. A MYGA does not, so just be aware of that. A MYGA is backed by the safety and security of that insurance company. And what they'll do is they go through, and in this type of a contract, anywhere from 2 to 20 years, the most common are between 2 and 9 years, and they will give you a guaranteed fixed rate of growth for that period of time. And so if you want a 3-year MYGA, you'll get it and they'll give you a 2%, a 4%, a 5%, 10%, whatever that rate is, and they will guarantee for that period of time. And much like a CD at a bank, when that period of time is over, you have the option to pull the funds out, to leave it right where it's at and see what the next rate of return would be for the next contract period of time. Sometimes the insurance companies will make you start a whole 2 for whatever the period of time is over again. Other times they'll just let it sit there and be a month to month type of option. But this is a great vehicle for growth and for safety and to be able to remove it from the chance of market volatility.
Okay, so those are all the positives. Well, we learned a long time ago, right, that no pancake is so flat it doesn't have two sides. I think I've heard you say that a time or two.
Mm-hmm.
So what are some drawbacks when it comes to a MYGA?
All right, now let's go ahead and talk about the market volatility piece. So by putting money into a MYGA, you have got a guaranteed rate of return for a period of time, which means that if the market corrects and it drops, you are not going to lose money. That's wonderful. Conversely, though, if the market takes off, we have another dot-com bubble or housing thing where for a period of time it just explodes. You're not going to be able to participate in that. And so that is something to be aware of. If you are looking for aggressive growth, this may not be the vehicle for you. You might want to find a financial advisor, put something more to an equity or something like that. Talk to somebody who's qualified to visit about that. Another drawback or another concern with this would be liquidity. That with much like a CD at a bank, you're putting money into a vehicle where you're going to you've got safety, you've got growth, but you are giving up that liquidity piece. So for this period of time, you should make sure that you've got plenty of liquid cash other places so that you don't have to dip into it. So quite often, insurance companies will let you have access to a portion of the premium that you have put into one of these contracts on an annual basis. So you can take out 5%, 10%, depending on the contract, depending on the company. So reduced liquidity is a big one. As far as you're going to be giving up potential market gains, but at the same time, you're losing any opportunity of loss. So that is a real positive here with it. A couple of the other things on it is that depending on the company and where it is, there could be a fee associated with it. However, there are a lot of companies out there, a lot of products out there where that you can get these without a fee, which is really nice. What else is there? Those are really the big ones as far as where it comes to
Okay.
some of the drawbacks with it.
So, who would be the ideal client for a MIGA? What would that look like? If you have a portfolio, I mean, give an idea to our listeners that this might be a good fit for them, or maybe not this product or this solution. We need to look at something different.
All right, now as we go through, every individual is different. So we want to make sure that we don't make broad sweeping recommendations for somebody out there for something like that. However, if we go through and we look at that, if I've got an individual that has got say they're a few years out from retirement and they're deeply concerned about where the market is at, then I am more concerned about not losing what I have than having huge gains. I would be happy with a 5% return for the next 5 years. All right, that would be that particular individual. Or let's say that I'm retired and I've got a chunk of money over here that I want to leave as a legacy for my family, for my kids. I don't want to lose it, but I would like some growth on it. So to kind of put it into something like that. Another one would be if we want to take a laddering approach and say, all right, I am 10 years out from retirement or 5 years out from retirement or something to that effect. And I want to make sure that I've got plenty of liquid money. I've got a couple $100,000 sitting over here that I don't need right now. What if I was to put, say, let's break it into four different chunks. So I'm going to put uh, $50,000 into a 4-year product, 50,000 into a 50,000 into a 2-year product, and then 50,000 into a 1-year product. And that 1 year might not even be a MIGA. That might be at a CD at a local credit union or bank that can give you a return. And so that each year you have something, a chunk of your money becoming liquid. So after 1 year, that 1-year product's going to be available. And then when you roll that into a 4-year product, then the next year later another piece comes in. So you've got a piece rolling through each year. That might be one strategy that could affect and could help folks with it. And the thing about it is that by doing that, you're able to look at different vehicles. Now, as we move into retirement, that we're talking about MIGAs right here, and right now they're really good. But in 2 years, 3 years, 4 years from now, they may not be. Maybe a CD at a bank might be better. Maybe there might be some other vehicle out there that would be better. So as we look at this, the rules are that we want to check each time that maybe it worked last year or the year before, but that doesn't mean that it's a good deal now. Does that make sense?
Are we talking about interest rates? Because you're comparing them to a CD at a
Mm-hmm.
bank. So when you're you're going in and you're saying, okay, I don't want lazy money, right? That's the last thing we want. We don't want, hey, let me just throw this 100,000 or 20,000, whatever, in the bank and watch it grow at 0.005%, right? So we don't want that. So we're looking for a solution, and we're thinking, okay, a MIGA or a CD at a bank. At that point, what are people comparing?
All right, and that's exactly it. Is they're comparing the interest rates. Multi-year guaranteed. That guaranteed part is the interest rate. And so you can have the same rate of return for the next few years, which is wonderful because you can absolutely plan on rates of return. You can absolutely, I put $100,000 in here. I've got a 5% rate of return for 5 years. I can go through and calculate exactly what my rate of return is going to be in 5 years. So I know that big chunk of money. If I've got a child that's going to be going to college, and all right, I've got this piece of money here, and in 3 years, I'm going to need tuition. And if I let it sit, I know that I'm going to have this exact amount for that tuition a few years from now. A couple other pieces to this again, and by doing that, we have removed it from market volatility. I want you to think about the people that retired in 2007. Now, we all know that the market had a huge correction in 2008. The S&P 500, depending on which report you look at, and people's portfolios on average lost somewhere between 37 and 50%. And if you put this money in at that point in time, and you got an interest rate on it, and it's safe, it's going, and we had a major market correction, they completely avoided that. And not only did they avoided that, they gained in those years. Now, should you go through and put your entire portfolio into something like this? No, that's not a solid strategy. But is it a one for a part of it? It potentially could be. The other nice thing about this is that depending on the tax status of funds, now I'm not an attorney, so I'm not giving legal advice. I'm not a CPA, so I'm not giving tax advice. But as far as if you look at it, that if you've got a account that is in an IRA or a 401k or some other tax deferred vehicle, that you can roll this over or do a transfer of funds into a MIGA, and you can maintain the tax status of those funds. So you can have tax deferred growth. If it's in an IRA, roll it into an IRA MIGA. And then that way you don't have to pay the taxes on it until, down the road when you actually take it out and use it as income. So that is another nice piece to this is a nice tax deferred growth. You can have growth with no chance of loss. You can have a fixed rate of growth so that you know exactly how much you're going to go ahead and calculate. And if something happens to you, that you've got your beneficiaries will receive 100% of the benefit of that. Now, that's something I talk about a lot.
Okay.
It used to be with annuities, if you passed away, that the insurance company kept all the money. And that was a big deal. I mean, I've talked to folks that are, in their 80s and 90s or a little bit older. And it's like, what do you know about annuity? And I mean, they're, it's terrible. I mean, they're spitting on the floor. They're saying it's a swear word, get out of my house kind of a thing. Because my parents had an annuity, and when they passed away, we didn't get anything. That's how they used to be. But that changed about, you started to see a shift in the insurance
Yeah.
industry about the 70s where that started to take place. So but that is such a big deal that I like to address it right up front with folks. It used to be that way. I acknowledge that. Not really anymore.
Yeah. So let's talk about the contracts for a second. So if you put your money into a MIGA, what do the contracts look like? How long are we talking? And is that adjustable? Is it flexible? Or once you stick
All
to
right,
it,
and the
that's what
answer to
it
that
is?
is it depends. Again, that there's not just a single company out there. For most part, and I'm going to speak in broad, sweeping generalities here, that most MIGAs are for a set period of time 2 years, 3 years, 4 years, 5 years. 2 to 9 is the most common. And you get a guaranteed rate of interest for that period of time. And then at the end of that period of time, there is generally a secondary fallback guaranteed rate of interest. Let me give you an example. So I went through, and this is actually something I did for a client here just a couple of weeks ago. We moved about $100,000 into a 5-year MIGA. They got a guaranteed interest rate of 5.75% for that first 5 years. And that interest is credited annually on their anniversary date. And the nice thing about it is that it's compounding. It's not just on the original principal, but you're earning interest on interest. At the end of that 5-year term, one of three things are going to happen. The client can take that entire account, withdraw the whole thing, or transfer it to another vehicle, walk away, happy, no fuss, no muss. Or they can leave it there and let it roll over or let it continue on. And most contracts will give a guaranteed secondary rate. This one gave a 1% guarantee in 5 years. What that means is, worst case scenario, they're going to be able to make 1% on that money. However, if the interest rates are better than that at that point in time, they'll be able to earn a higher rate for another guaranteed period of time. Keep in mind that the insurance companies want you to keep that money there. So they're going to give you the best rates they possibly can at that point in time. The third option is that if they can go ahead and if they leave it there, that they can go back and they can either roll it into a new contract with that same insurance company or roll it into another vehicle with somebody else. So again, it's a lot of options there, a lot of flexibility with it.
All right, for our listeners and they that are listening, they're thinking, you know what, a MIGA might have a place in my portfolio. What is their next step? What can
Well,
they
we've got a
do to
link
get a hold
below,
of you?
so go ahead and reach out to us at retirementfundamentals.org. Again, that's retirementfundamentals.org. There's a spot on there to book a call. Sit down with one of us or one of our trusted advisors, and we'll be able to see if this solution might be right for you, or if there's another solution out there that will be right for your specific situation. One of the nice things about this is that we don't take a cookie cutter approach, that we sit down and we visit with folks individually every single time, ask a series of questions, and try to find out what solution is right for you. This is not about just throwing a lot of spaghetti at the wall and hoping some of it sticks. It's about helping people's lives and educating them, which is why we do this, is that there's so much bad information out there. And we want to make sure that people are making decisions that are going to basically be there, that they're going to feel the impact of for the rest of their life.
Beautiful. Well, thank you so much, Ryan.
Go ahead and click the link below, send us a link, and who knows, your question might be on the next episode. But anything to do with retirement, we're here for you.